You've probably heard about hedge funds, right? They have this reputation for being these mysterious, super exclusive clubs for the ultra-rich, making these massive returns. But have you ever stopped and wondered, hey, can I get a piece of that? Well, today, we're going to break it down. Okay, so first things first, what exactly is a hedge fund? The simplest way to think about it is like a private investment partnership. They use really complicated strategies like leverage, which is basically borrowing tons of money to make their bets even bigger, and derivatives, which are like complex side bets on the market's direction. It's a very high-stakes game, and unlike the mutual funds in your 401k, it is not transparent. It's all very secretive.
So that's the real million-dollar question, isn't it? If these funds can be so lucrative, how does the average person get involved?
I think the best way to picture this is to imagine a hedge fund as the financial world's most exclusive VIP club. Seriously, there's a velvet rope, a very strict guest list, and a bouncer at the door designed to keep almost everyone out.
And here's the main reason why it's so exclusive. Because they use such risky and aggressive strategies, hedge funds have way fewer rules to follow than traditional funds. That lack of transparency, that secrecy, it's a huge part of their mystique, but it also means investors might be getting into something without fully understanding just how deep the water is.
And because of that massive risk, there are official, government-enforced rules about who's allowed to invest. This is that velvet rope we were talking about, and it's all built around something called the Accredited Investor Rule.
This rule isn't just some suggestion. It comes directly from the SEC. That's the Securities and Exchange Commission, under a rule called Regulation D. It says flat out that to invest directly in most hedge funds, you have to be what's known as an accredited investor. This is your golden ticket to the VIP room.
So, how do you get this golden ticket? Well, there are two main ways. The first is a net worth test. You need to have a net worth of over $1 million. And get this, that's excluding the value of your primary residence. If you don't clear the net worth hurdle, there's a second path, an income test. You need to have earned over $200,000 a year for the last 2 years, and you have to have a reasonable expectation of doing it again this year. If you're a married couple, that number bumps up to $300,000. You might be wondering, why make the walls so high? This quote here really gets to the heart of it. The idea is to protect people. The SEC's logic is that if you have that kind of money, you should, in theory, have the financial savvy to understand these really complex risks. And, maybe more importantly, you can afford to lose money if a big bet goes wrong.
So, the bottom line is pretty clear. For the vast, vast majority of us, the front door to this particular club is locked shut. Direct investment in a hedge fund is simply off limits.
But what if there's a side door? You know, even if you can't get past the bouncer, is there a way to at least get a sense of what's going on inside? Well, the answer is kinda. There are actually a few clever workarounds to get some indirect exposure. So, here's our game plan. We're going to look at 3 main alternatives, something called funds of funds, then replication funds, and finally, investing in the actual public companies that operate these hedge funds.
Okay, let's talk about those first two. Think of them as a cover band. They might not be the original artist, but they play the same songs and give you a really similar experience. Funds of funds are mutual funds that try to copy hedge fund strategies, and replication funds are often ETFs that just try to match their performance. The best part? Anyone can buy a ticket.
Now, here's another really smart way in. If you can't invest in the fund, why not invest in the company that runs the fund? Think about a massive, publicly traded asset manager like BlackRock. They have a whole division that handles these kinds of alternative investments. So when you buy stock in BlackRock, you're indirectly getting a piece of that action. So let's just put these two paths side by side. The direct route is exclusive. It has insanely high minimums, it's opaque, and it's less regulated. But that indirect, side door route, it's accessible to everyone, has low minimums, it's transparent, and it's regulated. You're basically trading that feeling of exclusivity for accessibility and, honestly, a lot more peace of mind. All right, let's boil this all down. What are the key things you really need to remember from all this? Here it is, short and sweet. Direct investing is a VIP club for the wealthy, and that's on purpose to protect everyone else from the high risks. But you're not totally locked out. You can get a slice of the pie indirectly through funds like ETFs that copy their strategies. And you can always invest in the big public companies that run them. And, you know, this all leads to a really interesting final thought. As these workarounds get more popular and more sophisticated, they're essentially opening up these once forbidden strategies to everybody.
So you have to ask yourself, are these side doors about to become the new main entrance for the everyday investor? It's definitely something to think about.